name is Melissa DeWeese, and I am so excited you are here to hang out with me and talk about insurance. Wait, don't go anywhere yet. I know insurance is not the most exciting topic, but there is a lot of important information that you need to know if you do have a health insurance policy or if you're an employer that's offering health benefits to your employees. I want to go over just very general information about open enrollment, what it is, what a qualifying event is, can you add or remove dependents, change plans. I'm going to spend just a few minutes on that. Then I'm going to go over basic benchmark information. I know that sounds super boring as well, but I promise it's so exciting because you get to understand what other employers are doing. What are your competitors doing? If you don't know what other employers are offering to employees, how do you know if your plan is good or not? How do you know if you're going to attract and retain the best talent? Also, if you're an employee and you're listening to this, you may want to know, does your plan suck? I hear a lot of employees say, my plan sucks. I don't like my plan. It doesn't cover anything. You might be shocked to find out what the average plan in the United States is currently, and you might be shocked to know how much it costs. I think a lot of employees are sheltered from costs because their employers are covering either all or the majority of the premium. I'm also going to touch on inflation. I'm going to talk about consumer price index versus medical inflation. And I'm also going to talk about what are the Q4 updates with these health insurance companies. Are we seeing medical inflation hit health plans yet? I don't know about you, but that sounds super exciting to me. Let's get into it. And this is just an excerpt from a presentation we did for a client recently. I'll just go over some basic open enrollment information with you, as many of you are probably renewing January or December, which is right around the corner. Your open enrollment is typically 1 month prior to your renewal date. If your renewal date is January 1st, your open enrollment is probably in the month of December. Q4 is crazy for my industry. We always joke, Q4 anxiety. Many of us have Q4 PTSD. Let's go over this general notice. This is for summary purposes and educational and entertainment purposes only. Please consult your summary plan description, your SBC, your EOC, your summary of plan doc, and some official policy documentation for your specific plan. This is just meant to be a general summary. Most people have open enrollment January 1st, so in this example, we are going to assume that you have an open enrollment in December, so it's usually the month prior. And open enrollment is the period of time where you can add or remove dependents or change plans. Many employers offer more than one option. So let's say you're on an HMO currently, and maybe you want a PPO. This is your time of year to make those changes. It's also the time of year where you can add or remove dependents without any questions asked. At other times during the year, you have to have what's called a qualifying event, which means that there has to be an involuntary or voluntary, sometimes loss of coverage for you to be able to add or remove dependents. Now, qualifying events certainly can be outside of that, just very general description, like a childbirth is a qualifying event for you to add your baby. A divorce is a qualifying event for you to remove your spouse. A court order to add a child or a spouse is a qualifying event. We follow all court orders. But in general, if you have a loss of coverage in some way, or your spouse has a loss of coverage in some way, or your qualified dependent has a loss of coverage in some way, that is a qualifying event for them to come onto your employer plan in the middle of the year. Now, at open enrollment, you don't have to worry about any of that, but I am going to just give a very general example of what I mean by qualifying event. Let's say it's your open enrollment and you enroll just yourself and you exclude your spouse or decline coverage for your spouse because your spouse has their own plan and they are enrolled under their employer's plan. In the middle of the plan year, perhaps they decide to change jobs or they get fired or get laid off or quit and therefore lose their benefits. This is a qualifying event for them to come onto your employer's health plan in the middle of the plan year, so you won't have to wait for open enrollment. If it's outside of that, if there's any reason outside of a qualifying event, you do have to wait for open enrollment. So the nice thing about open enrollment is that you can add or remove dependents without a qualifying event. You can also change plans. So if your employer is offering multiple plans, maybe they're offering an HMO and a PPO and an HSA, or multiple PPOs, I've seen some employers offering 10 gosh darn different options. This is your time to make those decisions and make those changes. Now, a qualifying event in the middle of the year is not the time where you can change plans. The plan that you choose at open enrollment, you are locked into for 12 months, usually. And what I mean by this, I have had employees who, let's say, have a baby, and they say, okay, now that I've had this baby, I want the platinum PPO. And this is a qualifying event for me to add my baby. Okay, great. We'll add the baby. Can I change plans? No, you cannot change plans in the middle of the plan year, even if you have a qualifying event. The only time you can change plans is at your open enrollment. So that employee that had the baby and wants to upgrade their plan can change plans at open enrollment. Hopefully I drove that home. Now let's just get into some general benchmarking information here. I'm just going to move myself so I'm not in the way as much. So this is from the Kaiser Foundation survey, and this is from 2021 information. So the average premium for single coverage back in 2000 was $2,471. So it was just over $2,400, $200 a month for employee only coverage. And family coverage was just under $6,500. Today in 2022, and this was from 2021, for single coverage, $7,739 per year. Family, $22,221 per year for a family. This bar graph really shows how costs have accelerated over time. Now, I like to show this sometimes to employees to bring home the fact that the employers have absorbed the majority of the cost for employees year after year for a very long time. And some employees are very sheltered from this reality. And what I do is oftentimes is explain this to employees in a graph, something like this, and also provide benefit statements. So it's a summary of your total income, or they're also known as total income statements. It's a great way to communicate to your employees exactly what their income is. It takes into account not only their salary, but all of the benefits that you're paying for, your 401k contributions, taxes you may be paying on behalf of the employees, and so on. So it really captures all that information so that the employee can see and understand the dollar amount that the employer is investing in their employee. One of the reasons that I really wanted to make this video has to do with inflation. So I think next year we're going to see health insurance coverage inflation kick up. And if you look at this graph, this shows you overall inflation, workers' earnings in this light blue, overall inflation is in dark blue, and family premiums are in this orange-yellow color. Okay. So here we have overall inflation. So since 2000, we've had relatively low inflation, 3% in 2000, then it jumped up to 4% during the housing crisis in 2008. Then it dropped to 0% in 2009. I mean, I vividly remember this, and it felt like negative 50% inflation. I mean, we had some major deflationary factors going on in that time. Then after 2010, we were floating around 1%, 2%, 1%, 2%. We had pretty low inflation for the last about 10 years. And as many of you know, this has now jumped up into the 8% range. Okay, so for the first time since the 1980s, healthcare inflation is below consumer price index inflation, which has not happened, like I said, in, 40 years? So you're going to see this graph change next year. This is going to jump up to this 8%, 9% range, and the workers' earnings are probably going to fall in, 6% or so. But the overall increase in the medical inflation that we are seeing this year is at about 5%. Now, I think that inflation may be stabilizing. It depends on what the Fed does. I mean, it's hard to tell the future when so much about the market and unfortunately is driven by the Fed nowadays. It has nothing to do with the economy. And it's hard to know what their future calculations are going to be, how they're going to do the reports, if they end up changing the way they calculate inflation anymore or any less, and what they just decide to include in that changes from time to time depending on what they want to show the public. But anyway, I digress. The average general deductible for single coverage. So this is showing, I think a lot of employees are very shocked at this number. I think a lot of employees are used to, and I don't blame them, they remember the days where they had a $200 or $500 deductible, and certainly, many employers do still have low deductibles, and God bless them. They're extremely employee-centric and wonderful, my favorite clients in the whole entire world, and are loving people and wonderful to work with. Love you so much. But unfortunately, there's been some businesses that are not able to keep up with the cost increases we've seen year over year with health insurance. And it's understandable that as costs go up, you downgrade the plan. So you started out in 2006 with a $500 deductible and you got a 20% increase. So in order to keep costs at a 10% increase, you go to a $600 deductible, and the next year you get a 10% increase. So you decide to jump to a $750 deductible. I mean, year over year, some of these companies, in order to balance their books and stay in business, they're having to downgrade their plan. And you can see that here. And also, you have to remember in 2010, this is when Obamacare came out, and Obamacare really pigeonholed the industry to very set specific standards for platinum, gold, silver, and bronze coverage is what you see. You see 4 metal tiers. And what that did is it increased a lot of the costs of premiums. There were some groups where I had 75% increases. I had one particular person, I remember their costs went up over 100%. And again, PTSD from those times. And not only did the costs go up, but a lot of times the people's deductibles went up because it was very difficult to match some of the older style plans to the newer style plans. So what I mean by that is, let's say I had a client that had a $1,000 deductible. Well, that first year that Obamacare came out, there were no $1,000 deductible plans. There were $0 deductible plans, and there were $2,000 deductible plans. So it was hard to put, it was like either you pay a lot more and you go to a 0, or you pay the same and you get a $2,000 deductible. I mean, these were the conversations we were having. So my point is that in 2010 and 2011, we saw people's deductibles go up significantly because of the additional costs, and there's lots of reasons for that. And if you want another video on all the reasons why costs went up with the Affordable Care Act, I am happy to break that down as well. Let me move myself again. You can see that there is a range here for single coverage of between $300 deductible and about a $600 deductible back in 2006. And over the years, this creeps up and up and up and up, and we're sitting at about a $1,400 and $1,700 deductible is the average in the United States. And I have some very corny memes because insurance generally puts people to sleep. So sometimes we throw these in there just to like shake it up to like, because it's just so corny and so weird and bizarre and not what most agencies put in their presentations that it kind of gets people laughing, whether they're laughing because it's such a corny thing and they're laughing at me because it's just ridiculous. That's fine. Whatever keeps people engaged, right? So friends don't let friends miss open enrollment. And I don't know who you are, but I will find you and I will make you complete open enrollment. So this is your HR manager at Open Enrollment, and they get all stressed out and all intense about getting all the paperwork. And I don't really blame them. To get into some of the increases, I know I had talked about previously how we've got medical inflation. Right now, I did another video, I can link it here, on medical inflation in 2022. And in 2022, in the beginning of 2023, we're expecting things to remain pretty stable at a 6 to 5% increase for the year. Now, many insurance carriers adjust their rates every quarter. And obviously, just because they're just adjusting their rates every quarter, this does not mean that your rates are adjusting every quarter. It's a way to look at the accumulative period of a 12-month period and see what the rates are going to be for the next quarter, or the increases are going to be for the next quarter. Let me break that down so that it doesn't sound like Chinese, because I know for many of you that probably didn't make any sense whatsoever. Let's say that you renewed January 1st, 2022, and you received a standard 5 to 6% increase. And that renewal is locked in generally for 12 months. Your rates will stay exactly the same until next January, which is coming up. Of course, there are other groups that renew throughout the year. It's not just January 1st renewals. There's February and March and April, May, all of the months of the year, there's renewals every single month. Come Q2, the insurance company will adjust their rates and update. They have to update all the agencies, the Department of Insurance and the state in which they are selling insurance, and they increase them 1, 2, 3% usually. It really does vary, but if Aetna stays on this track of this 4%, that means that a year from now, everyone that's renewing next fourth quarter, they will be getting a 16% increase, which is pretty significant. And we've got Anthem Blue Cross. Anthem is coming in at about a 1%. This is 1% per quarter. For PPO, it's 1.5%. For HMO, it's about 0.09%. So it's extremely low. It's basically a rate pass for their HMOs. So we can expect very low increases for HMOs in the next, 6 to 12 months for Anthem Blue Cross. Their PPOs are coming in at about 1.5%, so that's 4, 5, 6%, which is right in line with what our projections are for the near future of 2023. Now we've got Blue Shield. Blue Shield has had relatively low rates, below Anthem's for quite some time in most places. And we're starting to see that flip. Anthem was about 5%. We watched them just slowly catch up to Blue Shield. So Blue Shield was, at some point, was 20% less than Anthem when they went through all their rate adjustments several years ago. And every year we've seen, okay, now it's not at 20%, then it was 15%, then it was 10%, and it's been 5%. So if these changes continue, we're going to see Anthem and Blue Shield just neck and neck on most plans going forward in 2023. Average rate increase for Blue Shield is 2.7. Average increase for Blue Shield is 2.7% for PPO, 3.6% for HMO. So we're going to see about 12% increases with PPO, HMO, about 10, 11% increases there with Blue Shield. That is what is expected at this point. CalChoice, if you have CalChoice, It just all depends on which carriers you offer within CalChoice. CalChoice is a company where you can offer multiple carriers under one kind of broker carrier. It's built like an exchange. Then we've got Cigna. So Cigna, there is a rate pass for all new business, average 1.5 to 2% rate increase on the EPO and PPO plans in California. Cigna and Oscar has been just great rates, great administration. They're just knocking it out of the park. Been doing a really great job. And Kaiser has rate passes. There is some update in here from HealthNet as well, but I removed it because it didn't list what their quarter rate adjustments are. I couldn't figure out if it was 0% or not. But HealthNet usually falls somewhere in between Blue Shield and Anthem, somewhere around there. Average quarterly and rate annual increases in SoCal for United Healthcare. Q4 HMO plans went up 1%, Q4 PPO plans went up 2.5%, and the annual rate of change for PPO is 0.5%. Annual rate of change for HMO is 1.1%. Something to keep in mind here as well. So you'll be seeing this, and perhaps you get your renewal in Q4 and it's with United Healthcare and you got a 5 or 4% increase. You go, what the heck? Melissa said that this is the average annual rate. So this is average for their entire portfolio of PPO and their entire portfolio of HMO. Also, this does not include rate adjustments for age. So if you are an employer who has great retention, which many of my clients do, I mean, employees love the people I work with and nobody ever wants to leave. So every year, that's a great thing because you have low turnover and there's lots of costs associated with turnover, and employee retention is a wonderful thing to have. The downside to it is that every year your rates go up for your insurance because your employees are all 1 year older. So someone, over a 10-year period, your average age was 30. Well, in 10 years, your average age is going to be 40. So there's always about a 2, 3, sometimes even 5%, depending on your age demographics, cost at your renewal for the ages. Even if your plan only went up, let's say 1%, because your ages went up in your population, there's probably going to be another about 3% added in there for those age increases. One more thing. If you're a client, thank you so much. I love you. I appreciate all the testimonials that have been rolling in. Also, if you're not a client, I have a link down below for an application questionnaire. Once completed, we can hop on the phone together, probably about a 30-minute phone call to see if I can help you. Again, I appreciate you hanging out until the end, and I'll see you next time.